Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. Asian stocks rallied as US jobs data bolstered hopes for a soft landing in the US economy, while the yen edged higher and now even the BOJ's policy decision is out. US jobless claims fell to the lowest level since May, showing a healthy labor market despite slower hiring. This eased concerns that the Fed's recent 50 basis point rate cut was too late. In Japan, the BOJ kept rates unchanged, but traders must be definitely watching for hints for further hikes as inflation accelerates for the fourth consecutive month. Good morning, JK. With these developments, how do you see markets reacting today?
Hey, good morning, Suraj. Yes, there was a delayed celebration in the markets for the Fed rate cut, particularly in the stock market yesterday. And the celebration was more for removal of uncertainty and than just the rate cut that the market got from Fed, because Fed's statements, and particularly those of Powell, indicated that this was a preemptive cut, and it showed that Fed is clearly uh, trying to achieve a soft landing, and market seems to have a confidence that they are moving towards that, because Fed says the inflation is going to be closer to their target of 2%, and also while the job market is in a good place, they want to keep it there, and that's why they have gone for a 0.5% cut. And so the all the recessionary fears which the market carried some time back, due to which the markets were under pressure, have got removed. And if you remember, in the beginning of this month, when the stock markets caved in after the Labor Day holiday, that's when we were getting the sense that it was going to be a repeat of history. September is a very bad month for stocks generally, and that has got reversed with this move by Fed, and a big rally in stocks, starting with Japan yesterday. Then, in the US market, we had seen all the major indices, rally big time, and in general, risk got a boost yesterday, because we saw even the commodity have. Commodity pack has rallied. Brent rallying now. Brent is above 74. That's nearly about 7% from the lows that we have seen recently. And we have also seen the rally in copper and other commodities, which is really indicative that the market's fears of recession have receded, and looking forward to a positive environment. Even the yields, if you look at the 2 to 10 year yield difference, that was actually inverted to the steepest level since June 22. So the 10-year yield now trades at 3.71, whereas the 2-year yield now trades at 3.59. So that's clearly a change that we have seen, and also reflects what the market believes. However, for skeptics who thought that Fed had done too much too soon, there was some support for their line of thinking, because jobless claims came much lower, dropping by 12,000 from the previous week, and also much lower than what the market was expecting. And even the continued claims and the average claims were lower, and this indicated that job market was definitely uh, not as bad. It was uh, seen earlier with the unemployment rate inching up. So that not just that, we also had the Philly Fed Manufacturing Survey, which followed, the Empire State Manufacturing Survey that was announced on the Monday, and Philly Fed survey also showed manufacturing index rising in September, and most of the components were good, and importantly, the employment side was steady, and the prices paid were higher, and that gave support to the argument that Fed might have acted a bit soon on the the hawkish camp, rather the hawkish camp. Yes, hawkish camp had that support from their side. So. I think it's a mixed, view in the market still. However, markets have not stopped to celebrate, and they have continued even in Asia today. But yes, we also had some important developments. The Bank of England yesterday maintained their policy rate unchanged, and that was as widely expected. They were also saying that the rates need to be at a restricted level for much longer, and yes, that was not something that the market was not disappointed with that, because that was well expected. In fact, today also we had a central bank decision where Bank of Japan has maintained their rate unchanged at 0.25%. But this was also, seen with some caution, because the inflation data that was announced in Japan for Japan this month, today morning, was higher than expected. So it's only a matter of time that Bank of Japan considers another rate hike, and we have had several statements from BOJ members earlier in the month stating that when the economy moves in the direction in which they are anticipating, they will be acting on the rates once again. So on the currencies, of course, dollar has not made a new low. There was a good recovery in the morning yesterday, led by dollar yen, which went above 143. Euro has maintained its range between 1.11 and 1.12, unable to break the resistance there. Sterling, of course, has continued to outperform, with rates in its favor, or rather the interest rate differential in its favor compared to other major currencies. Now, the perhaps for us, the surprise pack was the rupee's performance, which also celebrated the Fed rate cut. But significantly, there was a big inflow for rupee, that we have seen, which which led the rupee higher towards 83.57 intraday, and but not surprisingly, as one would expect, nationalized banks were bidding below 83.60, and we saw the move back towards 83.70. Just to give you any perspective, the inflows by FIS this month has been to the tune of 7 billion, and this is the highest inflow that we have seen for this year in any month. And considering that, I think the move in the rupee is fully justified. And I mean, in normal circumstances, if rupee had been let to move freely by RBI in the face of overall dollar weakness, we could have seen rupee much stronger than these levels. However, their presence has not gone away, and even the latest trade data, which showed that exports underperforming, possibly the central bank would be mindful of keeping the rupee still steadier. Perhaps the range is now shifting towards 83.50 and 83.80, or slightly higher. And so that's the positive impact for the rupee from overall. So we have done with the major decisions of the central banks, and the next events to look forward to, of course, would be how the PCE and next set of jobs data from the US comes. That's what the market will be looking for, whether the Fed's action was fully, justified and achieving their objective of soft landing. Till then, I think markets are going to be steady. Yes.
Thank you, JK. And just quickly summarizing, the celebration for the markets continued yesterday with equities hitting all-time highs when it comes to the US market S&P 500 index. As recessionary fears have sort of gotten subdued, commodity pack has also rallied with oil prices, especially the Brent above trading above $74 a barrel. The 210 US yield curve uninversion has also continued. When it comes to monetary policy, Bank of England has maintained their policy rates unchanged. As they mentioned, rates need to be at restrictive levels for longer. This was also as per expectations. Bank of Japan has kept rates unchanged, but inflation was higher. So it's a matter of time before BOJ hikes again. For India, there was big inflows, which led to substantial appreciation for the rupee towards 83.57. And inflows this month by FIIs has been to the tune of 7 billion, which is also a substantial number. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets. Have a very good weekend. Tune in on Monday. I'm sorry.